Welcome to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management, and today is February 14th, Valentine's Day, 2024. We're going to be taking a look at the stock market, the overall health of the economy, and kind of the direction that we're expecting things to be going or heading in this tumultuous year. We've got an election year, quite a bit going on, still looming wars, and a little bit of pent up, I guess, sentiment on how the economy might handle things as we continue to see valuations being stretched in certain segments and sectors of the market, and others that continue to just kind of maybe trail the overall market, and trying to find the buffering spots where we can maybe find some potential and some opportunity for our clients to be making money. It's a little bit about some positioning tweaks, I think, along the way, and massaging things as we go. But I think a lot of things that are on the folks of our investors and our clients' minds right now is, are we too expensive? Are we too late in this cycle, despite a few hiccups that we've had over the last few years, with the exception of 2023? And even beyond that, what happened last year? You have some clients that watch the headlines that say, geez, market is up 20+%. My account is up 10%. I lost a 10% opportunity there. Where's my gain? Where is my alpha? Where am I trying to find value in my investments? And I think there's some things we have to look at when we take a closer look under the hood. And headlines only tell part of the story. Now, that doesn't sound great. I mean, you want to see numbers, you want to see results, you want to see your balances going up, and relatively speaking, it should follow a lot of what we see on the headlines on a broader market scale. So let's take a look at the broader markets right now and the indices and kind of where we are so far year to date in 2024. Again, just about a month and a half in. The S&P 500, top 500 stocks, up about 5% so far this year. If we move on to the Dow Jones Industrial, Dow Jones right now is up year to date. Yep, I'm waiting for my screen to refresh here, but about 1.7%. So it's definitely a little lower than the S&P 500. And then the NASDAQ, those tech-based companies we saw screaming and roaring last year, up again so far year to date, about 7.3%. So off to a very good start. And then the smaller companies, we look at the Russell 2000. That would be the smaller growing companies with a lot of kind of pent up growth potential there, but more volatility. Right now, pretty much flat so far in 2024. We look at things like energy. That is a sector that can be boom or bust for sure. So far, year to date is down about 1.5%. Financials, we know rates have been going up. It actually pays to have money in savings, CDs, and fixed income and bonds, and we'll talk more about that later. But so far, the financial sector this year is up almost 3.5%, singing a little bit of a different song. And then how about real estate? So real estate can be tough depending on what's going on with interest rates and things like that. We do certainly have a limited inventory, so that does play into the favor of real estate. But overall, the real estate sector so far is down about 2.5% so far, just a couple weeks, about 6 weeks into the year. And how about gold? We look there for preservation of wealth, some insurance, and maybe a little bit more of a defensive approach to things, is down about 3.3% so far this year. The digital currencies, we've got the major one, the one that draws a lot of attention, that is the Bitcoin. Bitcoin, under the Grayscale Bitcoin Trust, year to date is up a mere 25%. It's a big number, 25%, but it's no stranger to any of these coins. We know that cryptocurrencies are very volatile. They trade on momentum, so that's one thing to consider. There's no earnings there. It's not like a stock report we're waiting to hear about. It's more on how people feel about it and how they're trading. And if people are buying it, it's going to go up in value. And if they're not, then it could lose money. And then we look at the Grayscale Ethereum Trust, that's the ETH. That right now, year to date, is up about 18%. If we look at the final sector here, when we look at the digital currency, we have the Grayscale Litecoin Trust. Year to date, that is down about 9%. So we've seen quite a few trends. I mean, if you look across the board, the major one there we see is the S&P 500. That's the one that a lot of folks like to measure their investment performance against. How is my stock portfolio, my bond portfolio, my investment doing compared to the top 500 companies in the U.S.? And that's up over 5% so far. Little more than, I guess a little less than 1% a week, averaging just 6 weeks in. It's not a bad start to the new year. You know, coming off of what we saw last year in 2023, 1 year number on the top 500 companies is almost 21%. Now we have to put things into perspective. We know that the market does not always repeat itself. History does not always repeat itself. We can look at numbers and try to ascertain what might happen, but that's not always a good indication. You know, every market cycle is a little bit different, and we look at bull market cycles where we're making money and we're making headway and we're gaining some profits here. And those market cycles can be short at times. They could be 1 or 2 years, and they can go on many years, 5, 6, 7, 8 years. And I can tell you, with the exception of COVID and even escaping COVID that year, if you look at the 10-year number on most investment portfolios, they should be positive. You know, many clients up 10, 15 plus percent, and if they were more aggressive than that, you know, maybe they made a little more. But I think 2022 was a wake-up call when we think about and consider valuations on the stocks that we own. You know, you might be thinking to yourself, did I miss it? Is now the time to park in cash and wait until things improve to maybe invest, because I might be buying at a pretty expensive price when you think of a price to earnings multiple, whether it be on a forward earning basis or not. I can say that the early reports we're seeing, I think you're around 65, 70% of the companies are reporting earnings or an earnings beat. They're matching the numbers, the expectation of where things should be. So still low unemployment. The Fed is kind of taking a stance to pause on rate hikes. And a lot of people are forecasting that rates will come down this year, which could mean better positioning for companies looking to refinance, or maybe they have some loans that are either being called, coming due, or need to be refinanced. That also includes things like buying cars and buying homes and limited inventory. So that could play into the hands of those sectors as well. I can tell you that I was on the market, or am in the market right now, currently going through it, of buying a new car. If you look at across the board, pretty much from any of the major car makers, if you're buying an SUV, you're looking at $70,000 to $110,000, and that's not looking at just premium vehicles, depending on the options you're looking for. Now, yeah, you can buy some of the lower end cars, even with the bigger names, without the options that you're really looking for. Maybe not a warranty. You go out pre-owned, even the pre-owned market. So you look at some of the pre-owned inventory, there's not much out there. If you're looking for a specific color scheme or certain options, you're going to be limited. And I can tell you there's not going to be a ton of room for negotiation. Finding that out right now. I try to get about 10 years out of my vehicles, and we've been doing that for quite some time. It's worked well for us. Everybody's a little bit different, but if you can get 10 years out of your car, it's a depreciating asset. Maybe you put a little money into maintaining it. I think the money will be well spent. So with that, what's going on in 2024? Well, we think we've got a pretty contentious election coming up. We have a sitting president right now that is going to throw his hat in and raise his hand and try to do a good job of promoting himself and his team. And, depending on where you sit across the aisle, you may or may not be in agreement with that. But I think a lot of folks think that this term has been kind of a bust. I mean, the economy as a whole is okay. We're coming off of COVID, and we're coming off of a lot of money being pumped into the economy. We have higher inflation, we have low unemployment, and the Fed is in a very unique position right now for those folks who are looking to stash some cash in the banks. 6, 8, 10, 12 months ago, you could get paid or rewarded for doing that. The problem that people are finding is that there is risk in everything that you invest in. And when I say invest, it could be a short-term instrument like a CD. Could be a broker sold CD that we could offer to you. Could be a CD at a local bank or credit union. But what you're going to find is when you go to renew those CDs, those bonds, treasuries, whatever it might be, you're going to have reinvestment risk. And it's going to be based on the current environment of the rates at the time when you're shopping. So if you were able to grab 5.5%, 6%, 6, 8, 10 months ago, trying to find those same rates now, good luck. I can tell you I have clients that try to do it. We're attempting to kind of navigate that sector right now, and there's certain reasons that folks will invest in those instruments. It could be close to retirement. It could be another avenue. Maybe it's principal protection. Maybe something above and beyond what they're getting at the bank. So those are all considerations, things that we're helping our clients navigate right now. But I think the biggest question for most people is, when is the next shoe going to drop? When is the stock market going to go down another 15, 20%? Because it will happen. When, I don't know. But I can tell you this, trying to time the market is a challenge. And we're going to take a quick break, but when we come back, I want to look at some of the sectors that might be underappreciated, maybe not feeling the love. Again, it's Valentine's Day, kind of throwing in some of these cheesy comments. But in all seriousness, we're trying to find some opportunities, maybe uncover some gems, some hidden gems on some ideas on what we are thinking about for 2024. With that, let's take a quick break, and we'll be right back with the show.
Do you want help building and managing an investment portfolio that's right for you? One that will help you maximize growth potential while you're saving, help you generate income when you need it most, and eventually preserve what you've saved to leave to your beneficiaries? We do this day in and day out and take the stress and responsibility of making those decisions off your plate. Subscribe to our newsletter, read our blog post, and listen to our podcast to get a flavor of how we do things. Our firm is unique and capable of handling all your investment and insurance needs. Monarch Wealth Management, our guidance, your future.
Welcome back to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management. Again, on this lovely Valentine's Day, February 14th, 2024. Let's see if the market's feeling the love. We know where things stand so far this year, up about 5% for the broader market, the broader index, the S&P 500. But let's take a glimpse into the future. What are on the hearts and minds of a lot of our clients and investors? It's election season, right? It's an election year. It means a couple things. We've got some upcoming debates, some passionate, some heated debates, maybe some name calling. I'm sure we'll have a little bit of comedy. Certainly the elections have changed over the times. And we've seen that in the last couple debates. But it also means it's a natural resource, natural environment for a very volatile market, which might sound scary, like, oh, volatile, the market's going up, the market's going down, but it could also present some very good opportunity. And so I don't want that fear of the unknown, of what might happen, to be a deterrent from you entering the market. It could mean that you do it a little bit differently, a little bit more strategic about how you're placing money into the stock market, into the bond market, into your investments. And that's part of what we do day in and day out, working with our clients to make sure that they're doing the right things, the right activities. It's more habitual about those small things that you're doing, the small activities. I promise if you're doing those things, you're going to be working towards your goals. You will find that things will play to your favor over time. And it's not so much a gamble, but it's the activities, the behaviors that you're doing that help you more so than if it was today or at the end of the month or next week or next year on when you get into stocks. It's more the habit and time in the market investing. We know that. But anyway, fear not. Fear not, because knowing is power. Knowledge is power, and it can put you in the position to really harness that volatility. So when the market is going up and down, knowing that maybe some of these dividends are reinvesting and buying as prices are coming down. You like a sale as much as I do, but probably not as much as my wife. If it's on sale, it's almost a guarantee she's buying it. We might not need it, but she's probably buying it. Anyhow, knowledge is power. Taking a deeper dive, let's look at some of the historical trends that we've found, as things can sometimes be referenced as a financial roller coaster. And the market is very cyclical. So we want to use that or utilize that knowledge in those cycles to our favor. So buckle up. Here we go. Does history repeat itself? Well, kind of. A lot of times it rhymes. It's not the same repeat song, right? So let's rewind time just a little bit. How about market reactions in some of the other elections? And I've pointed this out in other podcasts and blogs that I've written. If we go back to not the last election where Biden won, but the one prior to that, where you had at the time President Trump running and campaigning, and folks and clients and friends and family would ask me, who's going to win this election? I did not think that it would be, at the time, Mr. Trump. And if you ask me what the outcome of the election would be in reference to the stock market, I would have said that things would have gone well had he lost. And just the opposite if he won. So if he did win, I expected the market would come down. And you've heard me, this is like a broken record. You've heard me say this time and time. And boy, would I have been wrong. And knowing that going in, we don't allow the emotions to dictate or drive our investment decision-making process. So we want to stay disciplined, and I would suggest that you do the same. But if we think about that, surprisingly well is how the market actually reacted to some elections. So if we go back to 1928, the S&P 500 has averaged 11.28%. So think about that, more than a 10% return in election years. Averaging, and that's going back to 1928. There's some good solid data there. Now, does that mean we're going to make 11%? We're already halfway there. We got another 6-7% to go. No, it doesn't mean that, but I want you to kind of keep that in the back of your head for just a minute. Positive gains in years where there is an election. 83% of the time, we have positive returns in those years, in election years. So hold on for just a second. Let's think about that. Does it matter who's in power? Well, I'm a Democrat. Well, I'm a Republican. Well, I'm independent. I want a Republican to win. I want a Democrat to win. What does that mean? Okay, if they're easier on the government, if they're easier on regulation, if they're easy with capital, and they're very accommodative to businesses as they grow and flourish, does that necessarily mean it's going to equate to positive returns in my investments? Well, possibly. Sometimes it takes years for these things to extrapolate out, but I will say that 83% of the times there is a positive return. Now, when we talk about parties specifically, Democrats win the White House, the average return is about 7.6%. 7.6. It's pretty darn good. However, when Republicans usher into office, there is a little bit higher return. And when I say a little bit higher, I mean a little more than double, about 15.3%. Kind of curious, right? Well, we think of traditionally the influence that a lot of these political parties have on the economy and the economics behind businesses, companies, corporations, the tax code, things like that, legislation. Republicans tend to be pro-business. Democrats tend to help facilitate and fund a lot of economic developments and programs by way of grants and funding and, raising some stimulus, which they have done in the past, some of it which I agree with, some maybe overdone. But in any event, that's just the circumstance. It's not my opinion. These are the real numbers. So that's kind of interesting, right? So you might think, oh, geez, maybe we want a Republican if I want my portfolio, my investment to do well. Well, that's not always the case. But anyhow, how about the incumbents? Okay, so when we think about incumbents and the trends and how they favor or maybe work against the market and their economy, historically, re-elections on average saw an average rate of return of 11.5%. And that's regardless of party affiliation. So you had a Democrat in power, on average, it's about 11.5% if they're going to continue their reign. Republican, same result, regardless of affiliation. How about presidents who are new into the office? So there's a shift in power. The incumbent is not taking over, continuing. There's a new person in office. That type of return on a new president is about 10.9%. Very handsome return. Very rewarding, you might think. Now, again, what's happened before doesn't mean it's going to continue that way. Past performance is certainly not a guarantee. Again, it can repeat itself in a certain way. History tends to rhyme and not repeat exactly to a T. But just keep that in perspective when you're thinking about, is this the right time to be putting money to work? Is this the right time to keep my investment allocation the way it is? Or do I need to change or monitor, maybe tweak my portfolio a little bit? How about the big boys? When we talk about value hunting, I've written a blog on this a few weeks back. There's some sectors that really have not performed so well in the last couple of years. We think of the tech giants, and there's, they call them the big seven. They have certainly been making some money as of the late, and that's early on in 2024. It's also what happened in 2023. So do they continue? I don't think that really matters so much. If you own positions in these, do you buy additional shares? Well, I don't know if now is the time, but maybe paring back is prudent. Taking some of those profits is prudent. I think a diversified portfolio is going to shine long term. Again, taking side bets on some of these high flying stocks and good performers can only run so long. But being diversified, I think, is a good way to uncover some gems. So when we think of gems, how about the bond market? Rising rates squeeze the bond market a little bit, right? Well, there could be a silver lining. So what's the silver lining with bonds and fixed income? Well, we talked about it before. It actually pays right now to save, to finding some of those investments and maybe increasing duration. If rates kind of ramped up, as rates go up, if you have a longer duration bond, you're going to get hit hard on the principal, on the NAV, right? And if rates remain flat or head south even a little bit, if you have a longer duration bond, you're going to see that price pick up in addition to the coupon of the bonds, the underlying positions. So there may be a good opportunity there to increase your duration on the bonds, looking at the type of bonds and how long you're holding them for. So one thing worth noting is that holdings, obviously in fixed income, you could get a nice juicy return with fixed income if rates stabilize or fall, which I think I'm more in the camp that they will stabilize and continue down this path, maybe not so much decreasing. Now, I'm probably in the minority, but that's just my opinion. How about this being a bumpy ride? Panic selling. I've never seen it done right. First of all, most folks will sell when they're down 25, 30%. That is not the time to sell. It is definitely not the time to sell. And time again, it is proven everyone wrong that tries to do that. They get out and they hold on to cash and they wait 12, 24, 48 months to get back in. In 2008, I can remember people even keeping money in a savings account because they did not even want to buy a CD. They said rates will go higher. They're at 6 or 7, they're going higher. They went down to 5, they went down to 4, 3.5, and 2, and so on and so forth. And it almost came a point in time where it paid nothing. You were owing the bank money to keep your money safe for you. So keep that into perspective. This election season is going to be bumpy, but I think that, the research that we're offering our clients in trying to find value in some of the value type of stocks, which are not trading at multiples that we're seeing with growth or technology, long-term could prove to be a very good investment opportunity. Long-term investing is a real win. It's the nature, it's the way that you're formulating your plan, it's the habits that you're doing over time, and it's a lot of little things that add up to something pretty big. It's like that in almost anything you do in life. You think about losing weight, and you think about being physically fit, or you think about any goal. If I say I want to become physically fit, well, what does that mean? Does it mean losing 20 pounds? Okay, over what time frame? What are the habits? What are the activities that I'm doing, to get to that goal? Same thing with retirement. You want to retire at 60. Well, what does that mean? Does retire mean retire from your job and get a part-time job and earn income doing something else that's fun? Maybe it does. Maybe it means relaxing on the beach, drinking margaritas, supplementing your income and Social Security. Maybe you have a pension. If not, it's coming from your non-retirement or your retirement savings. More and more importance is being placed on the individual habits of people saving for themselves. There's no more pensions. There's no more bailouts from the government. Social Security is going to be there in some fashion. Maybe you're going to be required to be a little bit older. Taxes, another thing to think about. But, there's a lot of things when we look at the stock market that come into play, that come to mind. I think it's pretty imperative that we be mindful of that and trying to find, although there might be some election jitters or some pricing jitters, that we try to find those market gems. And it's the small activities that we're doing with the portfolios as well, in addition to all the hard work that you folks are doing, being disciplined and sticking to your plan and adapting only if something in that plan, the goal or time horizon changes in your life, should you be radically changing your investment philosophy. With that, I think that's all the time we have for today's show. Thanks again for listening to the Pennywise Financial Podcast. This is Constantine here at Monarch Wealth Management signing off. Thanks again. Happy Valentine's Day, everyone.
You've been listening to Pennywise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is Pennywise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.